Good afternoon. My name is Jane O'Brien Davis. I'm a CLT specialist with the Canadian Network of Community Land Trusts. Welcome to our first afternoon session. This is Unlocking Community Capital, CLTs, and Community Bonds. Today, we're going to have a great presentation and discussion from three of our CLT practitioners who are involved in bonds with their organizations. Firstly, Angela Ho she is the community planner at Kensington Market Community Land Trust. Mike Bilthouse, who is the executive director of Ottawa Community Land Trust, and Zach Bradley, who is the co-director of development at the Kensington Market Community Land Trust. And this conversation is going to be moderated by Celia Wandio, who is the Technical Assistance Program Manager at the Canadian Network of Community Land Trusts. Celia.
All right. Hello, everybody. So again, these are our wonderful panelists, and that's me, Celia. So what we're going to be doing during this session, we're going to start off, I'll give you a very, very brief, I promise, very brief Community Bonds 101. Then we'll turn it over to our wonderful friends from Kensington Market to talk about their bond raises and their experiences with community bonds. Then we'll hear from Mike about Ottawa's experiences, and most of the time will be taken up with a Q&A. I'll start with some questions for our wonderful panelists, and then there will be opportunities for questions from all of you. So as we're talking, think about what information would be useful for the groups that you work with. We really want this Q&A to be a chance to kind of get into the weeds of, why use community bonds? How do you know if it's the right fit for your organization? So again, I know you're here because you're interested in community bonds, so you have a sense of what they are, but we want to get everybody on the same page just to ensure that we know what we're talking about when we say community bonds, right? So super elementary, we're breaking it up into two parts, the community piece, which describes who invests and who benefits, and the bonds piece, which is describing what the investment tool is. So the community piece first, community bonds are a form of community finance or community-based finance. They're one of many, many different tools. Community finance is kind of an umbrella term that's used for a wide range of tools that usually involve tapping into financial resources from within a given community rather than relying on or solely relying on external sources. There's a lot we can talk about in terms of the pros and cons of different community finance tools for different contexts, but today we're really focusing on this one tool, community bonds. So what is a bond? I know, again, so basic, but as someone who just opened their first TFSA this year, I think it's really useful to get everybody on the same page about these basic, financial tools. So the kind of cut and dry definition is that it's a fixed income instrument that represents a loan made by an investor to a borrower. Okay, so there's 5 main components we should think about when we think about bonds. First, there's the issuer or borrower. So that's the organization that wants money for a project, wants to borrow money. The kind of classic example we often think about is government bonds. So in that case, the issuer is whatever kind of level of government is issuing bonds to finance some project. Then, of course, there's the investor. That's the person or organization that is making the loan and expecting to earn interest on the loan. There's a cost, kind of a fixed cost associated with a bond. That's the amount that the investor has to pay, and it's the amount that they're loaning the issuer or borrower. There's an interest rate, so that's the amount of interest that the investor, is making on the bond, and it's usually expressed as a percentage of the cost paid annually. And then there's a term, so it's a kind of fixed term. This is the amount of time from when you buy the bond to when it matures and you get paid back that cost that you loaned in the first place. So now talking about community bonds, bringing these two pieces back together, similar to other kinds of bonds, they're interest-bearing loans with a given term, interest rate, and cost. Everyone's eyes glazing over when we say term and interest rate. But some key differences that kind of bring the community into it. The issuer, rather than being, government or some other corporation, it's a nonprofit or other social purpose organization that's borrowing to fund a project that will deliver community benefit. The investor, investing can be open to a wider range of individuals in addition to institutional investors. And the cost might start lower than with other forms of bonds, giving a lower barrier to entry. One thing I really want to highlight here, of course, is that community bonds are debt and risks are involved, and we'll hear more about kind of how to manage that from our speakers, but they also have a lot of benefits. So, the kind of why of buying and selling community bonds. For the investor, they're a way to invest money and get financial returns, like any other investment tool. But beyond that, they're a way to support values-aligned community projects. And for the issuer or borrower, that's the organization making the bond raise, they're a way to finance a capital project, of course, but beyond that, they're a way to involve community members rather than or in addition to banks and government in the financial gains delivered by a project. And the last thing that I'll mention is just kind of an overview of the community bonds campaign process. There are 4 main stages that you should be aware of. The first is assessing feasibility. So this is where you decide if doing community bonds really makes sense for your organization. This can be kind of a long stage of kind of figuring out what are your needs and is this the best tool to meet those needs. Then if you decide that it is, then you have to plan the campaign. So you're setting the bond options, you're deciding on the terms and the costs and the interest rates. You're doing some very deep business planning to ensure that financially this makes sense for your project and your organization. And you're maybe starting those initial communications with potential investors. Then you launch the campaign and do the bond raise. This is a pretty intense time of the process, of course. You're doing marketing and outreach, and you're managing those bond sales. And the final stage is then managing the bonds. So that involves doing regular interest disbursements to your investors. There are also tax requirements involved, and then there are all the things involved with the end of the bond terms, which is paying back those investors or potentially giving them an option to renew their bonds. And our fabulous speakers will talk more about each of these steps of the process. One thing that we want to highlight is, different groups will take different approaches to this process. And there's a question of, will you work with a consultant or will you go it alone? Most groups do work with a consultant to manage a number of these steps. The groups that you'll hear from have worked with Tapestry, who's in the room and at the booth back here. And I'm sure they're willing to tell you a lot more about this. But, and there are other ways of doing it as well. Some groups kind of do it on their own or hire a consultant for different parts of the process. One thing to really underscore is, again, there are risks. And so we don't recommend doing a DIY community bond raise if you don't have significant experience with the process. And no matter what approach you choose, your organization will need to put significant time and resources into this whole process. So that's something that you really need to think about, take seriously, and plan for. So with that, I'm going to pass it off to Angela to talk about Kensington Market's experiences.
Hello, everyone. My name is Angela, and I'm the community planner with the Kensington Market Community Land Trust. And over the last year and a half, I've been leading our community bond campaign along with my colleague, Zach. So this presentation will just provide an overview of how we use bonds and then also what it looked like in practice to run a community bond campaign. So quickly, just who we are. The Kensington Market Community Land Trust is a community-led nonprofit that acquires and manages land in Toronto's Kensington Market. We incorporated in 2017 after years of anti-gentrification and anti-displacement organizing. And our mandate is to acquire property, removing it from the pressure of the private real estate market and using land for community benefit. So for us, that looks like protecting affordability and also the unique character of Kensington Market. And we are unique as a land trust because we're one of the few in Canada that owns mixed-use properties. So our work in protecting affordability focuses on affordability for residents and also local businesses, recognizing that the connection between the two really is important in the overall health of the neighborhood. In terms of our background, we purchased our first building in 2021 at 5456 Kensington Avenue after a year of neighborhood organizing to resist the renovation of the building's existing tenants. And so we bought the building for about 6.5 million after tax, and we used a mixture of funding, including a $3 million forgivable loan from the City of Toronto, a $3.2 million traditional mortgage, and 550,000 in private loans. And so this included a vendor take-back mortgage as well as a private loan from a community member. And this building has 12 affordable residential units, as well as 5 commercial spaces. And in the last 4 years that we've been operating this building, we have been able to provide greater stability for our tenants while also gradually undertaking repairs. So definitely a huge win for the community to have been able to acquire that building. Now, in terms of how community bonds fit into our work, one of the main reasons why we decided to consider using community bonds is because, as you probably have heard throughout this conference so far, financing property acquisitions is challenging for nonprofit organizations like ours. Because the goal with every building we buy is to protect affordability, we have to be careful about the amount of debt that we take on because we don't want to pass on those higher costs to our tenants. And so we saw community bonds as a way to access lower interest debt and to leverage the support that we've built with our community over the years to advance our acquisition work. And so we launched our first community bond campaign last year with the goal of raising up to 2 million in bonds to repay our vendor take-back mortgage for our first building, and then to create an acquisition fund to buy a second. I've learned that different organizations will structure their community bond campaigns a little bit differently. So this graphic here just illustrates how we manage the flow of funds during our campaign. So essentially, when investors buy a bond, their money is deposited into a CNCLT's account. And from there, we move it into an escrow account that's managed by lawyers. And during this time, as we're building up bond funds, the money is invested into short-term GICs, and our investors earn a reduced interest rate. Once we have raised enough bonds and we've secured a property, then we are able to issue the bonds, and investors earn their full interest rate, and they receive their interest annually. So this process of holding funds in escrow is important for us because we can't issue bonds and pay that full interest until we actually have a building in place that will generate the revenue that's needed to pay back the interest for bondholders. And so for our first community bond campaign, we had 3 different investment options with interest rates ranging between 2.5 to 4.5% over 3, 5, and 7-year terms. And as you can see here, the majority of our bondholders came in at the Series A bond, the more accessible option, which had a lower minimum investment. But also the Series B and Series C bonds were really important in helping us reach our campaign targets. We had about 100, I think there's a bit of my content cut off, but we had about 170 investments for our first campaign. And one of those investments was from an institutional investor. The rest were from just individual community members and supporters. And through our first campaign, over the course of 8 months, we were able to raise $1 million in community bonds. So we used those funds to repay our vendor take-back mortgage and to acquire a second building. So with the second acquisition, really excited to share that earlier this year, after quite a lengthy process of reviewing potential properties, we were able to acquire this building at 380 Spadina. The building has 2 large residential units and 1 commercial space, and we bought the building for $2.1 million after tax. And our capital stack included a $1 million donation, about $860 in community bonds, as well as $450,000 in a forgivable loan from the City of Toronto. So you can see with this acquisition, we actually didn't take out a mortgage to buy this building. And one of the benefits of using community bonds in this case is that the average interest rate that we're paying through the bonds is lower than what the banks are offering us at the time. at around the same time, we also were working on a third acquisition at 302 Spadina. So we actually closed on this building a month after our second acquisition. And so this building has 26 affordable residential units and 11 commercial spaces, as well as a large parking lot in the back that can be redeveloped into affordable housing in the future. And the building also sits within the boundaries of two neighborhoods, Kensington and Chinatown. And so I think it presents a really exciting opportunity for us to deepen our partnerships with our neighbors, like the Chinatown Land Trust. And in terms of the acquisition details, we bought the building for $12.5 million after tax. Our capital stack included a $4.5 million donation, $2.8 million in forgivable loans from the City of Toronto, a $4.6 million mortgage, and $500,000 through a low-cost loan. So because of the timing of this acquisition, we did need to take out a mortgage. But the good thing is that the first 6 months of the mortgage is open, so we are going to be able to pay down a portion of that mortgage with community bonds. So similar to the first campaign, using community bonds, again, for this building is going to allow us to access lower interest debt. And to give you a sense of just what we're paying right now, like our mortgage is over 5% through the bank. And so shifting a portion of that financing to community bonds will then allow us to lower our costs as an organization. And so we can use those excess funds to, look at reducing rents for tenants or to support capital repairs. And for the second campaign, we have two investment options, so interest rates ranging between 2.5 and 3.5% over 3 and 5 year terms, and the goal is to raise $2 million by the end of the year. For our progress to date, we launched the campaign at the end of July, and as of this week, we've raised over $200,000 in bonds, and we also have an additional $200,000 that's been conditionally approved by a local foundation. And when I look at the numbers, it's interesting to see that about a quarter of our investments for this campaign is coming from existing investors, while the rest is just new investors. So I think that speaks to both how we have been able to build trust with our community and our investors, and then also the growing reach that we have, especially through our recent acquisition work. This is our campaign timeline. It's kind of a lot, but a couple of things to highlight here. The first being that our campaign took a lot longer to get off the ground than we had expected. So we began feasibility planning in 2023, but we didn't actually launch our campaign until 2024. And that was largely due to internal staffing challenges that we had, so resourcing constraints. Another thing to note with this timeline is that our campaign and our acquisition strategy was reliant on the assumption that we would receive external funding from the City of Toronto through their multi-unit residential acquisition program. And that funding program has its own timeline and isn't guaranteed to organizations. And so this was an unknown variable that we had to work with as we were raising bonds. For us, with our second acquisition, we were able to receive a private donation, which helped us bridge the financing gap and be a little less reliant on city funding. But it is important to note here that for us to use community bonds, we do need to leverage it alongside other funding sources like donations or forgivable loans. And then lastly, in terms of the timeline that we had sketched out to our investors, we had told them that our goal was to buy a building by the fall and then to issue bonds by the end of the year. But that didn't end up happening. We had to extend our timeline. We had a building that we were looking at, entered into an APS, but eventually just had to walk away from it due to some issues that came up in our due diligence process. And so what this meant was that we had to extend our timeline. Yeah, we bought a building earlier in the spring instead. And this meant just managing communications with investors, managing their expectations, and then also undertaking additional legal work to extend the campaign beyond the original timeline. So that was our first campaign, and this is our second, as you can see, a lot more straightforward. And this is largely because we have already secured our building prior to the start of our campaign. So it's made a massive difference, I think, in terms of how we can approach this work. What it allows us to do is that we can provide investors with exact details of what their investment will support, when their bonds will be issued. And having this clarity, I think, allows us to build stronger confidence in the campaign. So we have a much shorter timeline this time around, but we are hopeful that we'll be able to build on the momentum really quickly to get people on board. Oh no, my graph is cut off. Okay. This graph provides just an overview of the responsibilities that we had between KMCLT staff and Tapestry's team. And I would say for Tapestry, at a high level, the support that we received included advisory support. They helped prepare the legal documentation, the platform, and then on a day-to-day basis, they help us process investor applications. And at the end of each year, we'll take care of interest payouts and tax slips. On our end, I would say that the majority of the heavy lifting was during the pre-launch and raise phases. So some of this work included working with a housing consultant to do our financial modeling for the bonds, developing our bond options, developing the business plan, our marketing materials. And then once we launched, I would say the majority of my time shifted to investor outreach and engagement. So one-on-one outreach, responding to emails, speaking at events, hosting information sessions, doing targeted engagement. So a significant amount of work, I would say, during those phases. And then to give you an idea of what it takes to run a community bond campaign, this slide and the next provides a breakdown of the fees that we paid as well as the funding we received. And as you can see in the orange pie chart, the majority of our fees was made up of staff time and consultant fees. And the key takeaway here is that it does take a significant amount of resources to deliver a community bond campaign. Other costs that we had to pay included platform fees, legal fees, and marketing costs. And we estimated that, oh no, it's cut off. For the fees that we paid, we estimated it was about 130,000 that we spent for our first community bond campaign. And then on the funding side that we received, thankfully, because we were one of the first CLTs to issue community bonds, we did receive a portion of funding from Tapestry to cover our campaign costs. It was about 60,000, I believe. And then we also had to secure other major grants to support our work, and that totaled to just under 300,000. And so, yeah, in documenting these costs, just again, really important to illustrate that it does take significant resources to deliver a community bond campaign, and other organizations that may be considering this need to think about their staff capacity, funding resources, and as well their overall business plan before committing to raising community bonds. So yeah, that's been our experience in a nutshell. We can definitely share more during the Q&A, but I'll pass it off to Mike now.
Thanks, Angela. Sorry, that was really great. And I want to share our story. I will add that, like, we worked with Tapestry as well. And so there's a lot of details that Angela did share that I won't get into, but a lot of that structure is the same. But at the end of the day, we had a little bit, there's a few interesting kind of nuances and differences in our campaign as well. So I want to talk a little bit about how we have used community bonds in particular to help grow a revolving acquisition fund. But I wanted to emphasize while engaging community and collaborating with partners, because I think for us, we do recognize that there might be other ways to raise capital, but as a land trust, and this was a core way for us to introduce ourselves to the community and work with the community. And as we are about to launch another campaign next week, collaboration with partners is become a very central piece of our work. So similar to Kensington, we're a community land trust. We're relatively new. We were founded in 2021. And very early on, I would say the land trust was founded with the idea of filling a gap in the, I'll call it the affordable housing ecosystem in Ottawa. Lots of amazing operators and developers, but very few, if any, organizations that had a focus on preservation. And so raising capital to acquire and preserve existing affordable housing. So that was seen as very much one of our origin stories, I would say. And so, we were created with the idea of growing a community-owned portfolio. We really wanted to, in particular, identify the resources that would be needed to acquire those buildings. We do talk about securing land for future development, although our work to date has been primarily focused on the acquisition side. And when we buy those buildings, we don't want to become another housing operator. Again, in Ottawa, we have dozens of really amazing operators, and we don't want to compete or replicate what they're already doing. So we're very focused on staying in our lane, so to speak, and playing niche roles. And so we want to focus on asset management and ownership, make sure that those are quality buildings for tenants. But we want to partner with either a community-based property manager or a co-op or a housing nonprofit to operate those buildings. So, the stat that we often talk about in Ottawa is a 31-to-1 ratio. And what we're referring to there is that in the last 10 or 12 years, for every one new unit of affordable housing that gets built, we lose 31. We call it out the back door. And so these are units that are private stock in particular that are renting at rates of, that had been renting at rates of less than $1,000. And then when those buildings either sell and you have new owners that come in and either renovate or redevelop, or simply because we have vacancy decontrol in Ontario, when a unit turns over, those rents often rise quite dramatically. And so for every one new one that's built, we're losing 31 out the back door. And so that was sort of our, and that really is our headline story about what we're trying to intervene in, right? We're trying to say like preservation of those existing buildings is one solution to this. So I would say that we were very much created to help fill this gap, to create the entire gap that represents 30,000 units that were lost in 10 years. We're not quite at that capacity yet, but we're trying to get there to help fill that gap on a citywide basis. So in 2023, we went out and put an offer on our first building. We were 2 years old, and we were looking at what other land trusts, in particular Parkdale, in this case, had done, and a financial package that they had sort of developed working with VCIB. And so this is a 6-unit apartment building in the Carlington neighborhood of Ottawa. I think it was like 1.435 million. And we had the sense that we could probably piece some things together to help make this work, but it really was a bit of an experiment. And so we ended up financing it through a line of credit facility that we had from VCIB that we would pay down through various sources. We did have a municipal grant. We don't have a MURA-like program in Ottawa, but we had a counselor that had some accessible funds. We did receive a gift from an anonymous donor. That was significant for us because we're not a charitable organization, so we had never explicitly sought out philanthropic contributions. So that was very helpful. The rents in this building when we bought it were 63% of AMR, so our mortgage eligibility was incredibly limited. And so the last piece that we would need was some other form of investment, and we thought very early to look to the community through community bonds. And so already in the fall of 2023, our lender gave us the line of credit, knowing that we had this plan to raise community investment the following year. And so in the spring of 2024, we launched our first community bond campaign, Housing Forever Bonds. We needed to repay the remaining line of credit that we had on that first purchase, which was on Kirkwood Avenue. But we also thought if we're going to raise that capital, we knew we needed about 500,000 or 600,000. Let's try to do this at least 2 more times based on that same kind of portrait of a 6-unit building, and sought to raise 1.7 to help begin to grow this revolving acquisition fund to be able to respond to opportunities when they arose. So this was sort of our initial goal. Last May, we went out to the community and said we want to raise 1.72 million in community bonds to establish a revolving fund, and I'll explain that in a second, enabling the continued acquisition of multi-unit residential properties. And we were very clear that we had a goal of acquiring 3 properties in 2024. So for us, this is kind of the model that we had going into last year as we launch our next campaign next week. This is very much part of our marketing again. So we want to issue bonds to help grow this fund that we will then be able to use flexibly to respond to market opportunities or even off-market opportunities. We'll use these funds to acquire the properties quickly, have some predictability that we can close, hopefully eliminate the need for more costly lines of credit at financial institutions because they're really great, but they are usually higher interest rates. Once we secure a mortgage, those investment funds can be repatriated essentially either back into our revolving fund, or if our bondholders' term has expired, we would repay them their principal. They could choose to reinvest, but we want to make sure that their capital is available. So at the time that we get the mortgage, we either free those bonds up to purchase another property, hence the revolving nature, or we repay our initial investors. And that's really the kind of business model that we are looking to build and strengthen, I guess, with our first campaign. So similar to Kensington, we went out with a number of options. We had 4 options last year. Folks could invest between 3 and 7 years, earning between 3.5% and 4.5%. I will say that we had that bond series D, which was one way of acknowledging that some folks don't really want interest. They just want to know that their funds are safe. I think it was, I'm glad we tried it. I would say the uptake was minimal. I don't think that means that folks are not interested in donating their interest. I just think the way it was structured was maybe we could learn from that. Because I do think it's not uncommon. We've heard from others, we're not at that point yet, where when a bond expires, folks will say, you know what, just keep the interest, that's my donation. None of our bonds have yet expired. I am curious to see how that's going to go because as a non-charitable entity, we'll see what sort of response we see from that. So when we went out with our bond, and I guess I'll talk a little bit more now about the community engagement process. And this was sort of our 1-slide pitch to potential investors. We know there's a problem. We're in a housing crisis, and I really appreciate what Dr. Jones had to say this morning about that, but we do use this language. We're in a housing crisis, and yet every year we lose hundreds of private sector market affordable homes that residents need. So the OCLT thinks that we have part of a solution. I won't say we have the solution, but part of. So we envision acquiring these homes and securing vacant land and then placing these assets under community ownership. And the impact then is that by pooling these funds together, we can actually preserve these as affordable housing. Working together, something that wasn't possible before becomes a reality. There we go. So we launched our campaign just over a year ago in May, brought folks out to a local cafe, a lovely community-owned business. I would say that when we launched, we had 5 investments lined up, and 3 of them were all 5 of them were exciting. We had 350,000 in commitments on that first day. 3 of them were from local nonprofits, or 2 nonprofits and a housing co-op. And I think we really did then and continue now in this next campaign to build this as an opportunity for the community to invest in itself. And so the nonprofits on that day, one was the United Way, another was a community resource center, organizations that are interested in the well-being of the community and thought, we have reserves, let's invest some of those reserves and advance our mission in a different way. And so, and then that housing co-op did the same thing. And then we had a couple of individual donations. So we had some momentum right off the gate. Obviously, like then I think, you know, for us, getting media attention seemed challenging, but we had bloggers and that tended to be really effective. But what I wanted to focus here on is that corner where I talk about the local framing. And I think that, and maybe this was because we're a new organization, a lot of folks didn't know us, but I feel like a lot of the response and the momentum that was built in the community was less about, we want to support the OCLT, we love what they're doing, but more about community bonds were pretty novel in Ottawa. They're not novel across the country, but they were novel in Ottawa. And I think folks saw this as a new way that they weren't aware of before, that they could be part of a solution. And there's some power in that. And so I think, and as I talk about our next steps, I think we're really trying to leverage that this is less about the land trust and more about a new way for the community to come together on a community-wide basis and invest in housing responses. So we set off in May. By July, I think we had already raised over $1 million. And so we did put an offer on a second building. We were still in the case where we needed that line of credit, and we were going to repay that through a mortgage or our bond proceeds. We had chosen not to repay that line of credit right away, even though we had the bond proceeds, because we wanted to buy that third property. And I can't remember exactly what I have in the slides, but I will say that the Kensington model is really interesting in that the funds were initially deposited into an escrow account. We chose not to go that route because we thought that we would mobilize the funds quite quickly. And so we kept those funds, but what we have been able to do is invest those in a high interest savings account that is very close. So what we're earning on that is very close to what we owe our bondholders. So it hasn't been super challenging, but I will say that the 2 acquisitions that we had hoped to acquire in the past 6 months, we had to walk away from both of them because of environmental issues that sort of arose during our due diligence. So but at the end of the day, it's given us the flexibility to simply repay the line of credit with our bondholders. So as of today, we own 2 properties without any conventional mortgage because it is our bondholders doing that. And so the beauty of the fund is it's giving us the flexibility to allocate the funds as needed, given the situations that we kind of encounter. So we bought that 10-unit building. This was our timeline. We launched sales in May. So we had that goal of 1.7, which we reached by September, and the community kind of told us to keep going. So we expanded our goal to 3 million. For that, we did have to tweak our business model because, I mean, you want to be fully transparent with your investors that you have the capacity to repay them. So we retweaked that, and then by December had sold out and reached our 3 million goal. We opened our wait list right away, and as of today have well over 200 potential investors on that wait list that want to invest. This was our snapshot. So we had 133 unique investors make 140 investments. I would say that idea of tapping into nonprofits, we had a couple more come on board. We had some local businesses, we had some family foundations, so that even though in Series C, we've only got 11 investments, that was well over half of our total raise. And I think that was a really nice way, again, of the community showing different ways of investing in its neighbors and allowing us to reach that goal that much more quickly, so that for those who were investing 1,000 or 2,000, they were like, wow, this really does make a difference because they've already reached their goal. So I think we've got the momentum, we've got people investing smaller amounts, and some of those larger ones are really carrying us forward. All to say that wait list of over 200 has given us the inspiration to go back to the community. But I want to go back to that local framing where I think folks saw this as an opportunity to invest in affordable housing solutions and less about OCLT. So CCOC, the Centretown Citizens Ottawa Corporation, is quite different than us in that they've been around for 50 plus years. They own and manage 1,700 units of affordable housing, but also wanted to raise community investment. And we're going out with a community bond campaign. And we thought, well, why don't we market together? and use this as a platform for a community-wide kind of campaign to raise community investment for affordable housing. Down the road, we might restructure it into like one fund. Right now, we're going out as two issuers, but wanting to have one conversation with the community. The rationale for why we do what we do is similar. And so let's have one conversation. Community bonds are still rather new and novel for some folks. Let's try to explain that together. There's a lot of value going together. So we signed an MOU to work together and are now launching a joint campaign next week. So, and you know, talking about that capacity question, we're a small organization. Partnering with CCOC has been really lovely because they do have a little bit more capacity, especially on the comms and marketing side, which we see in some of their great visuals that we weren't able to create ourselves. So we're raising capital in the capital. OCLT and CCOC together envision acquiring and building more affordable homes and placing these assets under community ownership forever. This is what we share. And so our joint message to the community is that with your investment in Housing Forever bonds, we can make affordable housing in Ottawa a reality. So we're going out with like all of our marketing material is joint. Even our, I don't know that I have our series, but our series are the same. So we're launching common series. We are unfortunately not able to offer an RSP TFSA eligible option there, but otherwise, you know, we start with a 3-year, 1,000 minimum, 2.75%. Both of us are offering that bond. The next one is a 5-year, 5,000 minimum, 3%. We're both offering that bond. So we're trying to mirror each other's approach as much as possible. So we're looking to raise 10 million. CCOC is looking to raise 15 million. So we're marketing this as a $25 million community investment campaign, and I'm not nervous at all. Oh, there's our series. So yeah, so we have one chart that we're sharing with the community, and then there's a footnote that's not on this slide, but usually, oh, it is actually, that Series D is available from CCOC only. But otherwise, you know, talk to any of us at either organization, and we'll chat with you. At the end of the day, you need to invest in one or both, but we'll have that conversation together. And so next Wednesday, we're having a joint launch event. And again, I think because of this scale and sort of framed as a community-wide attempt, we've been able to get the mayor to come to the event next week. We've got some other sort of community leaders, and I think hope that we can build this as one kind of community conversation. And I will turn it back to Celia.
Okay, thank you both so much. That was wonderful. We have so much to discuss and so much to think about. So I'm going to start with a few questions to throw to all of you, and then in a few minutes, we'll have a chance to turn to all of you. Jane will come around with the microphone. Do make sure you speak into the microphone, either answering the questions or asking them, because we've got folks joining online. So then they'll be able to hear you as well. So the first question that I have, kind of coming off what you were just saying, Mike, about scale, I'm curious. I know you between these two organizations, you've discussed a lot throughout your processes. How do you think the scale of, you know, your bonds raised, but also of your community that you're serving impacts, you know, who's investing, how you market your bonds, Kensington Market being a, you know, small neighborhood within the big city of Toronto, and Ottawa being, you know, the whole city itself. How has that impacted your approach? And I think you'll just have to switch it on. There's a little on thing there. Yeah.
Can everyone hear me? Can everyone see us? We're kind of like sitting the same
You
way.
can stand up also if you want.
I'll just stand up so everyone can see. Yeah, I'd say first and foremost, yeah, I'm Zach. I'm from Kensington Market as well. Our neighborhood's only a few thousand people. So it's, in terms of a major city of 3 million people, we're a very, very small little enclave in the community. And I think that poses issues because it's like, you know, we can ask all our neighbors to give money and we're only gonna get a few 100,000, right? But it also, everyone knows who we are in Toronto, and some people across Canada know who we are too, right? Of their neighborhood and us as an organization. So I think it really struck some sort of, you know, nerve in people that like what we're calling for help, and this is a way to get involved. But yeah, in terms of scaling, there is some difficulties thinking about this because when we first launched, us in Ottawa, we were the first CLTs to do community bonds, right? And it was, wow, novel, exciting, right? And then soon but surely it's not going to be as novel anymore. Community land trusts were once really novel and interesting, and you know, it's more and more of us are popping up now, which is good. This is what we want, right? We're scaling in that way, but we have to be, I think, cognizant and aware that like that special factor for us is not going to be there forever, right? And that this market is going to become a financial market that has competition in it. So I think I think in the future, it's interesting to see what they're doing in Ottawa, because this might be a path forward too for us, where we as an organization don't need to be the ones raising money. Like our goal is to buy land. Our goal is to protect our community. We have a social finance arm now because we did it out of necessity and its values align for us, but it isn't what our main purpose is, right? So if there's a future where someone came forward and said, hi, I'm going to represent all the CLTs in Toronto, and we'll raise our own fund in Toronto, and we'll disperse that fund equitably, and we'll share it among the community. I think we would be very much interested in that, because it would save us time and we could focus on our community. Like as Angela said, the amount of money and time we spent in this bond is pretty wild. And we're at like social finance conferences now and talking on stuff, and we're like, Angela and I are like, this is not what we went to school for. This is not what we're trying to do, right? We're doing it out of necessity, right? And it's values aligned. So I think the future of scaling is more cooperation, more collaboration. And it's nice to see so many people here today to learn about community bonds, because we don't want to be the ones having to like, hold this in. We want to share this in a very, I think, equitable way.
No, I mean, I think I would like point again to the campaign that we're launching next week as part of our response to that question, right? And I echo, a lot of what Zach was just saying. Like, we're not going to be new and novel and unique for a long time. I think that, I mean, from the scale question, I think that being community-wide, as a land trust, we're regional. It's very different than a neighborhood-based land trust. So I think that already gave us, even last year, the opportunity to work with groups like the United Way, who invested without, I think, the worry of, well, what if this other neighborhood asks us for an investment, or this neighborhood? We are the Ottawa Land Trust. They are the United Way serving Ottawa. So there's a scalar fit, to use a really nerdy term. And then I think that, yeah, the campaign that we're now launching, I think it's also sort of based on like, why would we want to create an environment where every organization needs to build that capacity? Like Zach and Angela, this wasn't my background. So let's, try to minimize that need and that duplication. And I think also for investors who, are not, we would like to avoid a situation where an investor is approached by 6 or 8 different organizations. Competition is healthy, but at the end of the day, do they then sort of turn away because they're like, how do I decide? Like, somebody tell me which one is the best one. And so I think we're trying to add that as sort of a value add for a potential investor. So we'll see. Like, we're launching next Wednesday. We don't know how that's going to go, but I think that in one way, the way we're structuring that is sort of a bit of our response to that question.
Amazing. Thank you. Did you have anything to add in? Okay, fabulous. So thinking about who invested in your different bonds, how did you manage and how are you managing communications with those investors? And have there been any challenges? Have you had to kind of tailor the way you're communicating with different kind of parts of your investor pool, depending on whether they're institutional investors or community members? Any kind of experiences you can share around that?
I would say that initially when we started our campaign, we had a wait list, and those were folks in the community who were really excited to support our community bond campaign. And then once we launched, I think with the marketing that we had, we were able to build our audience. So a lot of folks who were coming in that were new to just even what CLTs were. So I think in addition to having to explain what community bonds were, it was like also just talking about what we do as a CLT, what is the landscape, and what is our goals. I think also in my experience, I've come across a lot of like new investors. And so even having to break down the terms of what the bonds are, having to explain the legal documentation and like what that all means, even like as someone who was trying to figure it out myself, I think that was definitely a really important role, like translating what exactly we're offering for our investment and providing both the assurance that we knew what we were going to do. So I think, yeah, a lot of that helping first-time investors kind of get on board was a big role that I had to play in the communication with our investors.
Amazing.
I mean, I think I would add that I sometimes worry about a lot of things. One of them is that, we're a land trust, and sorry, what I'm trying to say is I think like we're member led. As a land trust, we don't want there to be any barriers to becoming involved in the work of OCLT and the work of the movement, right? This is about communities organizing. And so in response to your question, one of my first thoughts is, I think in a lot of our communications as an organization, I don't know that we have a great line between this is a member communication and this is an investor communication. And so we communicate with both at the same time. That's not inherently problematic, but I want to ensure that as an organization, we don't become known as, oh, that's an organization where you invest money, because I think that could become a barrier. And so, I mean, that's maybe a bit of a tangent to your question, but that is something that I've been thinking about. And, you know, because at the end of the day, our communications are much like they are with our members. So we share with them both our sort of day-to-day work, but we also bring them into, you know, we usually include updates from other land trusts across the country and the movement and so on, and more about what we do. I will just add one last point, which is kind of unrelated to those, and that is, you know, there's a full offering statement and trust agreement and business plan that are super important. And I wonder, of the 133 investors, how many folks read all of those documents. I think that in this work, we find that a lot of folks invest because of their belief in the mission and their belief in us as an organization. They either know, you know, folks that are on our board, they trust us, there's credibility, and that's almost enough. And they're like, okay, I'm behind that. And we hear that more often. And that, I think, is incredibly powerful and lovely and beautiful, and also compels us to be even more careful that we follow our due diligence in ensuring an offering that is like financially sound.
Yeah.
That was a really wandering.
No, it was good.
Yeah, I'll say to that, I feel like once we raised $1 million, I think Angela and I were like, oh fuck, we have $1 million. And people are just, you know, very supportive of the work we're doing. And it's a great honor, but it's also very scary. And I think two other things to say is, one, like we noticed this where people come up to us and like Dominique, the co-director, would talk to people in the community and she'd say, are you a member of the land trust? And they go, oh, I can't afford it. Right. And it's like, oh no, like that's like, you can buy a bond, but that doesn't, you don't need to become a member. You just got to live or work in our community to become a member. So there was communications, and we're still working on that to say, by the way, membership is free, right? These things are separate. So there is some difficulties that come when your organization gets too wound together with this community finance tool, right? And it's like, we're trying to make it our everything, but if you don't talk about it and do it a lot, you can't raise the money. So there is an interesting balance there. And on the inverse, though, I think it's been really cool because people, like Angela said, they don't know what a community land trust is. They don't know anything about this. They don't even know what's going on in the city. But you talk to them and you're like, something's fucked up. Like, do you feel that in society, right? You like, something's going on, and people are like, I feel that. And then they learn about it, and then they want to get involved. But normally it would be like, hey, like, do you want to come volunteer with us? And someone's like, no, I work full time, or I have a family. I can't come and do these things. You know what I mean? I might watch a YouTube video. I might follow you on social media and like your posts, but I can't do much more. And that's okay, because most people can't, because many people are struggling to get by or just are at capacity, right? So I think the bond was a nice opportunity where we can say, hey, this is your way to get involved. Is maybe you're making some money and you have excess investments, like put your investments here. And I think that link has brought a lot of people into the movement. So now they're like, we've had people come to our events and they're like, I'm an investor. And then now they're at the events and now they're coming and they want to get involved now. And maybe they would never have gotten involved if it wasn't for this. So I think there is a really nice link that way too.
Yeah, amazing. Quick plug, both KMCLT and OCLT have great newsletters. So you should subscribe. They share really great updates and other interesting information. Kind of related to what you both just mentioned, quick one. If you were to kind of draw a Venn diagram of your investors and your membership, like what is that overlap? Do you have a sense of, you know, are most of your investors who are kind of individuals, are they also members? Are a lot of them, you know, residents in your service area? What does that look like, and how have you kind of gotten a sense of that?
I think with our investors, actually the majority are not folks who live in the community. There are some who have invested, but I think the majority are just folks who care about the market and want to do something about the issues they're seeing. We have had a lot more investors after buying a bond join our membership, but I would say for the most part, I don't know if there's a ton of overlap in our membership and with our investors, but there probably could be more communication you can do between the two to expand the options for them.
Yeah, I mean, I think there's some overlap. I don't think there's a ton of overlap. I think it's probably also fair to say that there's some investors who might be like, I'm a member now that I've invested, right? So there's probably a little bit of clarity that we need to continue to work through on that, but some overlap, but not a lot, I don't think.
The one thing I'll say is that we just bought a building, the last one there, and one of our tenants in the building bought a bond. So
No
it's like a
way.
really interesting idea where it's like they pay rent to us to help pay down the bond. It's like things are kind of going full circle here in a really beautiful way. And that's something that I'd love to find ways to get more and more of our tenants involved. And maybe there's a future where they can get higher rates or reduced rates or an easier way to invest or some sort of way that way. So that's happening, which was really cool to see. And that was, we didn't even ask them. We just saw that name come up and we're like, oh, wow, this matches the thing, right? So that was cool.
Wow, that's cool. It's kind of a way of enabling tenants to build equity while they're still renting, kind of indirectly, right? That's so interesting.
Exactly. Yeah.
Yeah.
Like, we're not a cooperative, but we
No.
also have like tenants can run for our board. So it's like you could have a tenant who's on the board making decisions about their building and then they're earning interest from the building too. So it's in many ways, it's like a way through us to create that really like, tenant governance, but also tenant like interest bearing.
Yeah. Okay, I'll do a couple more and then we've got a lot of time for questions from all of y'all. So I hope you're thinking of some tricky questions for our brilliant panelists. Not to trick them, but to get good information. So which one do I want to go to? What are some kind of non-financial positive impacts that you've seen? I know you've touched on this a bit, but maybe to get a bit more into what have raising community bonds enabled you to do in your community in terms of connecting with people, making them feel they have a stake in your organization.
I think being able to provide a space for people to invest their money in a way that's values aligned has been really important. Like when I speak to investors, they're so happy that they can invest their money in a neighborhood that they care about, that they know will go towards a good cause. Because I think a lot of the more traditional investment options, you don't know what you're supporting, or you may be supporting issues that aren't aligned with your own values, climate change, war. And so I think being able to provide a local investment option that resonates with people is something that we've been able to do. And then also, I think in the last year and a half that we've been running our campaign, we've definitely grown our audience. If Instagram metrics are worthwhile, like at the beginning of our campaign, we had under 1,000 people following us, and now we have over 2,000. And we've grown our memberships quite significantly, I would say. And so I think just being able to expand our audience so that, folks both within Kensington Market and also beyond are now, aware and supporting our work, I think has been a really great benefit of our work.
I think the one thing that just comes to mind is like, I truly believe that we need all kinds of approaches to kind of foster the social change and housing justice that I think we're all working for. We need activists, we need advocates. And I think that one of the things that folks are drawn to with the land trust through this campaign is that the perception is that we are like advocating and I'm happy to critique the system, but I think we're sort of recognized more as trying to do something about it and trying to do something in response. And so I remember talking to a member who came to our AGM back in May, and I was amazed that he was there because I knew like he had a lot going on in his life right now. And he's like, no, this is like just being in this space. I feel this positive energy. And I think there's something to that, right? I think, again, I think we need all those approaches, but at the end of the day, I think we're trying to shift the narrative a little bit. Like we are a community that has a lot going for it. We've got resources, we've got assets and so on. And we're trying to shift that scarcity mindset a little bit to one of, what can we do by working together? And so, yeah, I don't know. I'm kind of excited by that. I don't want to overplay that. But I do think I think there's value in that.
And I think two things come to mind for me is one is like, it's a form of mutual aid in a way. It's a form of challenging not the entire, because we have so much work to do still, right? But it's like, we get so focused on, okay, what's the goal? The goal is getting land, right? But then it's like, to get that goal, if we just focus on that and we do it by any means necessary, then are we any different than the systems we're trying to change? So I think for us, like the community bond was brought forward really early on by our board. And I see Kevin here, who was very instrumental in bringing this idea out, is that like, if we're going to get money, like where's the money coming from, right? If we're going to hire contractors, where's that going to go, right? Who are we going to hire? It's just the idea of the entire way down. We're trying to wonder where that is and how we can improve the system. And we can't be perfect on everything, right? Because that's putting way too much expectations on us. But this is one way where it's like, okay, instead of getting a mortgage, we get community financing. And it's like, it's a pretty big difference, right? Like everyone's putting their money into a bank and the bank's giving that money to us. So it's like, cut them out, right? If we can. I do like VCIB, but thank you for your mortgage. But like, you know, that's another way that like we need to lead by example. I think if we're saying this, we're making this talk, we're trying to be bold and radical, but then we just follow existing patterns, then it's just marketing and branding that we're doing. So we actually have to lead by example. And the other one is that it's been interesting to enter spaces that we're talking about finance, because these are folks that are very different. We kind of are in a bubble here, you know. We're kind of in this very radical CLT space where I'll say something and everyone might nod their head, but a lot of people don't know what we're doing, and a lot of people just this isn't there in these words they don't know, they're not involved. But when I talk to them, when I go to some of these social finance things, and these are very much finance people in suits, like they get it, or they're interested, or they're super curious, or they have the, you know, I mean, they're struggling in some other ways, or they know someone like this, or they're thinking about it in an innovative way or whatever. But it's been nice too to enter different spaces, and the community bond campaign has allowed us to do that. So I think it's a nice opportunity that way.
Amazing. And last question for me before I turn it to all of y'all. I know, because I get to chat with you all quite a bit, that you're really busy. You have a lot going on. I think people can tell from your presentations as well. You have so much going on. How has kind of, doing every part of the community bonds process kind of impacted your workload as staff of these CLTs? What have been the kind of resource and cost implications kind of on the operating side of making this happen? And, are there any things that you wish you knew at the outset that you wish you'd planned for?
Well, I have the mic. Yeah, it's a lot of work. It's nice because there's so many external benefits, like we were mentioning, right? But I do wonder if another organization came to me and said, "Hey, I want to do this," whether I would say yes or no, like whether I would encourage or not, right? Because it is a lot of work. Yeah. It is a lot of risk, right? It's like you're doing these models and all this stuff, and you're looking at it, and it's like at the end of the day, it's you as the organization or the board who's deciding to go forward, right? And taking on $1, $2, $3 million of debt is not a light ask, right? And when you're buying people's properties, these are people's homes, right? So it's like, this is like an idea in theory is really fun, but at the end of the day, it's someone's house. So it's like, you got to be really sure what you're doing. So I think we were really lucky to get grants and to get funding and to hire someone amazing like Angela and to work together and be with our community and have strong support of our board and other staff. I see Dominique in the back. Like we have a really big team effort here, so we were able to pull this off, and we had strong help from Tapestry and a lot of folks to go together, right? But it's like I'm not sure if like looking back, if we didn't have all these things in place. And like Angela mentioned, we were lucky to get a donation to help us buy our first building. We were banking on getting certain city funding, and it was delayed. So we were at a point where if we didn't get that city funding, we might have had to return all our investments, and the whole campaign would have gone, you know. So it was a risk, but we took on too, right? So I've never been someone, when someone comes to me and says, "Should I launch a community bond?" that I say yes. I say, like, you know, you should do a lot of work. You should talk to us. You should talk to Tapestry, talk to friends, and do your research and cross your I's or dot your T's or whatever they say that is, you know. Because it's like, I don't know, maybe if there was a low-cost financing available, that might be the better solution, right? If a foundation was saying, "Hey, I can give you a loan for $1 million at 3%," does that have the same whole impact? Likely not, right? Because there's all these things we're talking about. But what is your goal as an organization? And is getting money from a foundation is definitely maybe not as good as doing a community bond campaign, but it's not as attractive as a mortgage. So I think that like being focused on what your goal and your mandate is really important, because maybe you're trying to work in a marginalized community. Maybe we're talking about land back for Indigenous groups. Maybe we're talking about so many other topics where the social finance aspect isn't the key point. So it's like, I think you need to remain focused on what your vision is and what your focus is and where that fits in. And it's not for everyone, because maybe in some cases, like it's better left to just get a low-cost loan from a foundation that's values aligned.
Yeah, I echo all of that. I think the thought that's coming to mind is like, again, we've got a small team, but you know, this is when the team really matters. And so Glenn, my colleague here who supports our operations, because there's a lot of like day-to-day and week-to-week stuff when the campaign is live, in terms of like your communications with investors and just facilitating the process and so on. I guess I'm someone who tends to look at the big picture, absolutely. And you know, I think there are some certain key fundamentals that have to be in place. That financial model needs to be rock solid. You know, certain things of the process need to be there. I think beyond that, like the campaign takes a life of its own. And I don't say that, I don't mean to be like too light in saying that, but I think that the numbers of investors that we had who, you know, came to us not because of a direct communications from us, a direct reach out, but, you know, they talked to somebody in their network, they talked to a friend, a family member, a colleague, et cetera. And so I say that in response to this question, because I don't think it has to just be the capacity that we have as an organization. We're also trying to, facilitate a community conversation. And when people start talking to each other, that increases the demand on us. And so that there's a time piece there. But I think a lot of the work of the marketing and promotions becomes organic. And that's a big help. I would give a shout out to Tapestry. I think working with them was the only way that we could have done this. And they brought a lot of expertise. And then the last thing that I would say is, and it was something that you said, Zach, that kind of prompted this is, absolutely, maybe there are tools out there, like financial tools, that when we look at our expenses, and Angela's slide is really great in sort of mapping that out, that maybe we could find something that offers a similar kind of, financial incentive for us. But I think we are about community engagement. And I think, we've seen people learn about the housing crisis through this. I think we've also seen, one of the community health centers that invested with us last year, when they first looked at this, the board was involved. They realized that they had an organizational policy that precluded them from making this kind of an investment. They actually went through the effort of changing their policy so that they could make the investment because they saw the value of like community wealth building and investing in community. So I think there are all of these other spin-offs that come from it, which I guess is a bit of a tangent from your question, but I just think there are other ways of seeing the value in the work that goes into it.
I think the one other thing I'll add, which Zach touched on, but the responsibility piece when running a community bond campaign is quite significant. Like, you are handling a lot of sensitive information. I'm meeting with investors at cafes and they're giving me their SIN numbers, their checks, and their personal details. And as an organization, I feel like because we're still up and coming in terms of our internal processes, when people ask like, oh, how are you handling this information? What are you going to do with the data after? I felt like that was something that we still had to figure out as we were raising bonds. And so just recognizing that there is a lot of responsibility and it can have really significant impact on people when you don't manage that information well. So something to consider.
Yeah, great points. Okay, we're going to start passing it around to the audience. And Jane's got the microphone. I think first question just here in the front.
Thank you. I mean, community financial tools have been around for a long, long time. I mean, CLT is the most recent invention, if you wish. But if I look at the rich history of cooperatives in Canada, this has been going on for years. And maybe just to give an example of Nova Scotia, I mean, Nova Scotia had in the 90s community economic development funds that were part of a provincial legislation. And I had worked on one. And when we did it, we needed to have a financial business plan that was approved by the Securities Commission. So my question would be, in terms of Ontario, for example, what kind of interface do you have with the Provincial Securities Commission?
Suzanne, I see you there.
As an investor, that's why it's there.
Yes, so there is absolutely sorry, I'll stand back here so everyone can take a look. Hi, Suzanne Pfizer from Tapestry Community Capital. So the way that community bonds are done is that we are operating under a prospectus exemption, right? That that is under National Instrument 45-106. It's also known as the prospectus exemption. And there's specific legislation that enables nonprofits and charities in Canada to raise community investment from everyday investors without a prospectus, right? So this way, no organization actually has to go through their provincial securities regulator in order to issue these. What this also means is that Tapestry, for example, like legally, OCLT and KMCLT don't have to provide any offering statement, trust agreements, or business plans to you, but we make you do that. It'd be just to actually build trust in order to do that. Complex, and Mike, I take your point that honestly, it should be 3 pages at the front being like, this is what the risks are, here's what you should be, we're working on that. But yeah, like that's actually how you bypass it, right? The challenge is if you're a nonprofit co-op, Now in Ontario, you will be working under FSRA, which is the Financial Securities and Regulatory Authority, which means that they will actually receipt your statement and then decide whether or not they want to actually allow you to do that. That can be a challenge. And then if you're in BC or any other province, you will be going through your securities regulator. But if you're a nonprofit or charity, this is like the cleanest way to actually raise investment, unless you want to go through other exemptions in the thing. But even Quebec. So this is how Group TAC, Beaubien Cinema, etc., Brick Par Brick, etc., is raising community bonds because they are nonprofits, and the exemption is at national level. And so then each province adopts a particular version or adds or subtracts, but it is consistent in Quebec.
Okay, I think Jaka has a question. Sorry, it's a very long room. There's a lot of running around necessary.
Thanks. This might be a technical question, but trying to understand, like, building out your funding stack, if there's like a sweet spot between all the different types of funding that you had in place, to be able to achieve your campaign, and setting your goal of what you're going to raise through the bonds versus, okay, we're going to target this amount in donations, we're going to target this amount through traditional finance or non-repayable or forgivable loan. And if that was something you had to figure out upfront, or it just so happened that here's how much we were able to get through donations or grants or whatnot, and then the rest we're getting through bonds.
Yeah, so for us, our first campaign, we modeled it on an 8-unit building. So we knew there was a building for sale near our neighborhood. We knew what the price roughly was. For that, I put together just a financial pro forma, like a model to see what we could get. We knew what the rents would be. So roughly we knew, okay, this building is going to cost around 2 something. We know there's 8 units. The affordable rents we want to charge is here. We know what the utilities are. So we kind of understand, like, this is how much money the building would give us every year in revenue from rents. This is how much money it's going to cost in utilities. That leaves us a net profit. And then that net profit is what we need to carve out from to pay back interest. So from that, we can kind of calculate how much interest we can take on. So if I know for that building, you're going to have a profit of 40,000 a year, then we have, you don't want to spend all 40,000 on interest because you have no money at the end of the year. So maybe I want to spend 30,000 on interest on that building. So then you kind of work backwards and okay, if I want to raise 1 million and I want to charge 3% or something, right? Then you can figure out from there how you get that. So that's how we did it for the modeling for that. We ended up buying a smaller building, a different layout. So we had to adjust our raise. By that point, we were in around 1 million in raising funds. We were aiming for 2 million originally. So it just kind of happened when we looked at this building, we modeled it, we had some donations, we had grants, we plugged in 1 million in community bonds, and it was actually too much. Like, we didn't need that much debt because we had extra grants. So we lowered it to about 860 something around there. And then that's how we bought that building. The building that we have now, we modeled it on no community bonds at all. We modeled it on getting a mortgage. So we calculated it that, like, the max interest we could take with the current revenues was around a $4.6 million mortgage, and that's at 5.2%. So the building can live as is right now. It's totally fine. We just thought, hey, we already did all this work for the community bond campaign before. Let's do another bond, and we'll lower that debt. So if the building already functions at 5.2% interest on 4.6 million, what if we put 2 million of that down to 3.5% interest? That's extra profit that we get every year. As Angela mentioned, we can use that now to maybe go to all our tenants and say, hey, we're going to lower your rents by a few $100s, or hey, we're going to actually fix the roof, or we might do this project, or we would put that money into staff funding, or we put that extra money into another project we're going to buy. So I think it's all in the initial pro forma, all in the initial numbers, right? Just like, we never want to take off too much debt. We never want to take on too much debt. That's the first thing I look at when I look at any acquisition is, what's the revenue? What's the cost? How much debt can you take on? Because you can't increase the cost. Look, once you buy this building, you can't just go to tenants and be like, oh, sorry, I really messed up the modeling there, and I'm going to charge you guys all $400 more a month. Is that okay? Or I can't go to a foundation and say, hey, I want to get a grant. Like, what's the grant for? I'm like, to pay off debt to a bank or to this. Like, no one wants to give you that kind of money. No foundation wants to help you pay off debt. It's really annoying. It would be nice, right? But I haven't come across that yet.
Yeah, I think I would largely echo. I mean, I think we look at every property on a property by property basis, dependent on what capital is available. And so, when we bought our first building, and I think I said that those rents on average were 63% of AMR, there's no way we could have bought that building with just community investment and a traditional mortgage. We needed the significant city grant and that anonymous gift. This past summer, one of the buildings that we were really hopeful to acquire was one that we were trying for the first time to close without any non-repayable capital, so no grants and no donations. And that building would have, from day one, the units would have been averaging 100% of CMHC's AMR, and that made it viable. So I think depending on the capital that's available would determine what building we look at to buy. We have an acquisition policy that allows us to go up to and even a little bit above 100% of AMR, also knowing that given we are a nonprofit, within 10 years, those rents are going to become more and more affordable relative to real market rents. But yeah, I think what we look at, similar to what Zach was saying, like the pro forma on a building by building basis.
I think we have a question from Norm here. Oh, sorry. Yeah, go.
Actually, I have two questions, if it's okay. One quick one for KMCLT. I saw donations were a big part of your capital stack. Sorry. Where did they come from? And if you can share that information, because for one of the buildings, I think it was like $3 million.
Yeah, who's on this one?
How about type of thing?
Yeah, we worked with someone near our community, and they worked with the foundation as well to get them. And yeah, we can't say too much on it, but yeah.
Foundation. Okay.
Maybe I'll add that I think the community bond campaign maybe helped bring more awareness to folks who might have not have even known about us and might not have considered a large donation. So I think that's a benefit of the community bonds, is that you're attracting donors as well.
If I understood well, both presentations, on KMCLT side, your community bonds are at the center of your capital stack, and for OCLT, it's transitory. Could you explain why you're using them that way, both of you?
I think for us, it was inherent to the way in which our organization was born. I think our initial funding as an organization was through, some of you might know, CMHC's Demonstrations Initiatives funding program. And the application that we had put in was to kind of test the development of a community-driven revolving acquisition fund. So that was always very core. And I think I'll add to that our board, and I think our organizational culture has always been one that draws from the cooperative and nonprofit experience, but also private sector experience and blending of models that might be less known within the nonprofit world, but the willing kind of adoption of them. And so, yeah, for us, I think it's always been seen as a transitory piece.
I think for us, it's rooted in the mutual aid aspect of it, that we want to, if we're going to go through this work to make this tool, then this tool can repay every year. So it's like, for us, if we can transfer more and more of our debt towards community bonds, I think that's the best solution, because then we're sharing money back to individuals rather than back to a bank. And having said that, though, it's like we want to get to a place where we pay no debt, right? It's like we don't want people's rents to go towards private individuals who are making money. We talk about definancialization of housing, but we are very much talking about finance right now. So it's like, it's the better of the two, or what do you mean? It's like if we have to take on debt to buy buildings, which we do, we're going to use the bonds. If we could find a way, if someone said, hey, here's a bunch of money, and we can eventually get to a place where we can pay down all these bonds, that would be really nice too, right? Because then we could lower rents and people could have a truly living in no ideas of profit, right? But I think for the meantime, it's like we have no desire to take on other forms of debt. This is probably the best type of debt that we can take on, right? So it's what we're looking for.
Do you realize that you're running businesses now? You're running for-profit businesses, you're managing investors. Was it your intent to actually end up running business? Because these are set up as nonprofits, but now you're forced to make what I call ethical profits in order to be able to do good things in community. The government is requiring you to make profits and self-finance this good work. and I call them ethical profits to differentiate them from those other profits, the normal developers and all the other profit makers in the world. And this should be nonprofit work, but they're forcing you to actually finance it yourselves rather than the government financing it, which is the old way. Some of us are old enough to remember when government actually financed and paid nonprofits to do this work. Now they're making you make the money to actually do it. Do you know you're running businesses and you're running profitable businesses and awesome, but it's a giant shift in the social contract.
You mind if I go first? Yeah, it's like it's a great point because it's what we're doing, right? And there's two lenses that I see it through where we're in this private system in Toronto, especially where the cost of real estate is so high, where it's like even the city of Toronto gives us funding. The multi-unit residential acquisition fund is really nice. They give you $200,000 per unit. You can't find a property in Toronto where it's $200,000 per unit. So by virtue, they're giving you this grant, expecting you to fill in the gaps. What is that gaps? That's private financing, right? And normally I'd say get a mortgage and go with the bank, right? So off the get-go, the government isn't filling the whole cup, right? So we're reliant on private financing. So I think in my mind, it's like, this is the better of the alternative, right? It's either we go to the bank or we do this, we make our own business and we share the money. There's a lot of positive that we say about community financing, that we're sharing money with people. We know sometimes who the people are, but do we really know who these people are? Like, is it someone who really needs this money, right? And that kind of worries me sometimes, where I'm like, I'm paying someone 3.5% interest. The interest is coming from rents. Who is that person? Do they need that money? I don't know, right? It's not like we have like everyone in our community is holding hands and we're all putting the money together here, right? It's like, it's probably not, it's probably people who already have wealth that are getting more wealth and they're getting it off affordable housing. So if you look at it through that lens, it's very dark. But it's like, we need to do this, right? We can't sit here and wait for the perfect solution and say, I'm not moving forward until I get 100% government funding, because then nothing will get built in our community. Nothing will get preserved and protected. And I think that we have to think a bit through the lens of quote unquote leverage, right? And it's like this kind of gross word that we actually do think of, because if someone gave me $1 million, do I buy $1 million building? Or do I raise another $1 million and buy a $2 million building? Right? Do I take that one donation or that one thing and then I raise bonds and then put it together and buy something bigger? So it's a way for us to it's like diluting, right? They give us a little bit of a solution, and instead of just applying that, we're adding water to it to make more stuff, right? So there's a balance there, because you don't want to lose the focus of what you want and what you're going for, but yeah.
Anything to add? Okay, I think, yeah, Jane's on it.
I'm wondering, okay, so I think it was Angela said that like one of the really good things is that you've been able to get the word out, and then more folks have donated because they've like heard about the bond campaign. I'm wondering if it ever happens in the reverse, where like, especially when we're talking about things like United Way using their reserves in a bond where they might have otherwise donated, but because this is available, instead they're doing it through like a community bond, and whether there's any risk of like reducing capital gifts because you're using this model.
I mean, I tend to think it's a minimal risk. Obviously, we're not an organization that has sought out, philanthropic kind of donation, so I can't do a comparison based on our experience. I think the United Way in the case that I raised, so they invested 100,000. That is not money that would have been granted to the community in another program, right? These are reserves that the organization has, that a good organization should have in case they have issues because of funding changes and whatnot. So, they're drawing from a different pot than I think otherwise would be allocated. I know that there are some organizations who run concurrent, like philanthropic and investment campaigns, and I think they might have some different reflections. But I think certainly in our marketing, that sounds very business-like, building on the last thread of the conversation. But I think we really try to emphasize that this is not a donation, right? Like, you might not be in a position to give a donation, and that's okay. And so I don't know. I think we're targeting a different group, but welcome others.
Any thoughts on that from Kensington's perspective?
For us, we received an institutional investment from a foundation that I don't think would have even donated to us. Like they were out of the GTA. And so I think in our experience, we haven't had a lot of institutional investors to begin with, but I think it is opening us the opportunity to tap into other large organizations that can direct their internal resources to us.
Yeah.
Yeah, it was actually interesting because a lot of these foundations, like you can go and say, hey, can you give us and donate us money? But people might not make time to have a conversation with you. But we approach a lot of these foundations, other rooms saying, hey, do you want to make an investment? And then they're talking to us. And then once we're there, we're like, oh, you can also donate to us, by the way. That's also an option, right? And so it is nice to kind of open some doors that way, right? But it is frustrating when you're dealing with some of these foundations. You're looking at their reserves, you're looking at what they're operating and what they're, how much money they actually have. And you're just like, wow, okay, one, we're asking for peanuts here. Two, it's like we're asking you to give money so you can make money off us, right? So it's like, it is a strange conversation to be having.
I think we've got time for one, maybe two more questions, depending on speed.
Hi, everybody. So I have a question for Mike. My name's Catherine. I've been doing some work with Mike. So having done a first community bonds campaign, having like surpassed that initial goal, how did you approach goal setting in terms of like the $10 million money number for this second campaign? I'm just curious. Obviously, the first one was very successful, but what's the process to assess, reflect on a first bonds campaign and come up with a number goal for the second one?
Super scientific approach to that. No, I think it is. I mean, part of it is, so we're looking at our wait list, right? And our wait list is almost now twice the size of the number of investors in our first round. That got us to 3 million. So, some easy math there. I think there is momentum that we know has been built. I think the number of, I think I illustrated that the investors in Series B and C, the numbers of actual investors are much smaller, but the amounts are larger. And I think that some of those initial ones kind of prove the case for how other organizations and small businesses and foundations can do that. So I think we've heard, largely anecdotally, but I think we've heard from a good number of them that we have reason to believe that more of those kind of signature investments will come in. So I think it's a combination of, the stats of the wait list and the interest that we've genuinely heard about, but also a belief in the kind of community conversation that we're having. And then at the end of the day, I mean, honestly, obviously, I think we all know that even 25 million is scratching the surface of the wealth that is in our community. And so at that level, we know it's viable. I think it becomes a question of continuing to get the word out.
Okay. Last one.
Hi. So I sit on the board of a CLT, and then I work for a CDFI. And so I'm really thinking about, like, this is very exciting. And if we decided to launch something, like how the CDFI could take some of the burden off the CLT so we could work on this together. And so I'm curious to what extent you worked with CDFIs. And if you didn't, what parts of the work can you see yourself outsourcing or wanting to outsource? Like Angela mentioned, there was no secure place to store the data. Like we have that as a CDFI. So I was just thinking, like, what are some of those connections that you made or wish you could have made? Community development financial institution. Sorry, do you not call them?
They don't.
The US.
They don't exist in the same way here.
Okay, what do you all call credit unions? Okay,
We have
credit
those.
unions. I'm sorry.
Yeah.
We're from the US. I thought it was on the slide, so I thought it was.
Oh, it was. Yeah, it was.
No.
I gave that as an example because some people are aware of. Yeah, it's like another tool, but no, we don't.
Oh, I was like, oh,
We
same
many
thing.
wish that we did
Okay,
have them in
great.
the same way
Sorry.
here.
So
Yeah.
we can
No,
talk
no.
about that later, but credit unions, like, or other financial institutions, if you have a similar to CDFI.
I mean, I don't know that we have a natural like go-to in the way that you're describing for the roles that I think you're talking about. I will say that so all of, and I think Angela explained this really well in the presentation about the ways the funds transfer, they just come into our accounts electronically. We had thought initially about working with an external fund manager. I think we've kind of realized that at this point, the scale doesn't necessarily require that. That might be something that we outsource, I'll say, or work with a fund manager at some point. I can see some value in that. And then I think the other piece is that like the relationship that we have with Tapestry, again, it's not so much the storage of data, but the annual issuing of T5 statements for tax purposes and things like that, and ensuring that we stay on track with our schedule of interest payments and so on. That would be quite cumbersome for we're a 1.4 FTE organization. But working with Tapestry helps us in that too. So I guess we're doing some of that through Tapestry. yeah, I'll leave it there for us.
I think with the way we've approached our community bond campaign, there's also a very personal approach. Like Zach and I have gone to people's homes to pick up checks. And so I think there's that element that can't be outsourced and it has to be done by folks in the community where there is that trust. But certainly a really interesting idea.
Maybe this is what leads to some downfalls in some ways, but I'm deeply skeptical of involving too many people through the process. And maybe the CDFI or whatever it is very values aligned and very nimble. But I do worry about like talking about fund channels that then get siphoned off, and then there's people taking a cut each way down, right? And then you have an organization with, you know, dozens of people that their main job is to raise funds. Like we have these in Canada now. The government pumped in a bunch of money through social finances, right? I'm thinking of like Bond Impact and these other ones, right? And it's like they have like dozens of people working there, and their whole job is to take money and put money elsewhere, right? And I'm just like, so they're getting paid somehow, right? And that money is going from you as an investor to me trying to buy the building, and then somehow I have people in suits taking the money between, right? Or I have people who have an office space, people who have this. So it's like, I think we as a nonprofit need to be very, very skeptical and watch out very carefully about who is saying they're trying to help us, because they might be helping you, they might be values aligned, but they're taking your money. And I think that we need to be careful in that. And you know what I mean? So being very nimble and being very is the best way, but you don't want to overwork yourself also, right? So if there is an organization that says, hey, I'll do all this for you, this is how you do it. And that's where transparency is really important. So I think if you're looking at a partner to work with, like, yeah, just let them show you exactly the breakdown of their funds, because we don't want people to work for free, of course, right? We want people to be getting meaningful work, right? But it's like the balance is good.
Thank you, everyone. Round of applause for our speakers and moderators.